Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these my charts. This is all my own original work, as I think you deserve to have that. So with that, Chicago soybeans. Before I get down to this week's action, I think I should set the scene. So 23 weeks ago I highlighted a bright pink July 24 to date rectangle pattern. That's currently 959 even to 1100 even. This pattern is still operational even now, and last week we were closing in on the lower trend line. We're also back then for about a week and a half testing a longer term pattern, a bright green 2019 to date uptrend, currently at 969 3/4. And these explain the hesitation seen over last week and the week before. Overall, we've been following the outcome of the mid-July break lower below the bright red late April to mid-July expanding wedge pattern before that, made up from the fairly flattish upper trend line on my daily chart, which is currently at 1100, which linked the highs from the two tops of May to June, based double top, and the lower trend line below, currently at 999. This was made up from the lows between mid-April to mid-July. The move lower took a while to start, but it did start, and 5 weeks ago I commented, and I quote, "So whilst it's a bit early, I still thought it appropriate to set up some potential targets below for the bright red expanding wedge pattern." Thus, a primary target X would be in the 991 zone, tying in with the lows of March and April, whilst the secondary, harder to reach target X1 would be down in the 944 zone, tying in with the September 2020 low at 942 and the August last year low at 940. End of quote. 4 weeks ago, prices reached the primary target X down in the 991 zone, as well as the primary target for an earlier mentioned double top pattern down at 994. The market then pulled back up for a bit before resuming the move lower and creating a bearish halfway hesitation between early July and last week, reaching down to target X2 at 970, the secondary and harder to reach target for the double top pattern. In all this process, we saw a quite steep bear channel developing from late June to this week, highlighted in dark blue on my daily chart. Now, I then commented last week, and I quote, "It will now be interesting to see whether the bearish pressure will push prices down even further and still remain within the dark blue bear channel, or will the old bright green uptrend or the more recent bright pink uptrend, which after all is only a 2-pointer, whether they will disrupt the bearish pressure." End of quote. Well, disrupt the bearish pressure they surely did, as we have seen this week, starting with an immediate countering key reversal up on Monday and following on through after that, such that prices broke up and out of the dark blue bear channel and back within the bright red descending expanding wedge pattern, not meeting much resistance at the neckline, currently at 1009 of the late July to mid-September 2024 reverse head and shoulders pattern, nor the October 2020 low at 1016 3/4. But finally starting to see prices slow down and get capped by the combination of the declining green short medium moving average, currently 1023, the 50% Fibonacci on the June to August 25 move at 1022, the flatlining gold long moving average, currently at 1026, the broken lower time, currently at 1030, of the December 2024 to April 25 bullish shift pitch hawk, and the mauve medium moving average, currently at 1031 3/4. Basically, the next overhead congestion in depth area between about 1016 3/4 up to 1031 1/2. Now, this move up has caused a number of events to occur. Firstly, the dark blue bear channel and the descending expanding wedge pattern will now be downgraded, and the remaining target X1 below at 944 will be retired. It will also mean that, much as last week I was watching to see if the colourful support below would hold, and today I'm now looking to see if the colourful resistance overhead would hold. and will cap prices or not? That is the question here for this week, and as I speak I notice we are set up now for a daily key reversal coming off that, whatever the collective noun is, coming off those overhead colourful resistances. So if we close tonight either over 10.24 under 10.12 and 3/4, then we'd be on. Anything in between would have a lesser outside day pattern. At the moment we're looking like we're closing below it. Chicago soybean meal. 18 weeks ago linked some of the recent highs into a bright red downtrend that tied in nicely back then for a while with the descending long moving average, currently 295.5. The long moving average was then just about shadowing the downtrend, but a little higher up along with the medium moving average, currently at 289 even, which earlier had failed to provide much resistance above, but then energized itself as a resistance, and quite a good one, over mid-May to mid-June. Despite 12 weeks ago closing above this bright red trend line, indeed those closes proved to be a false break higher, and it was only in late June for a clear break below the next drawn trend line, which is the purple lower trend line, of what together initially was a descending triangle and later morphed into a descending wedge pattern. As I mentioned, the break higher was a false break, and in late June we finally had a break lower. However, it took two separate goes and a third one early last week at the retesting back up towards the lower purple trend line, now teamed up with the resistance from the August 2020 low at 281.90 to affirm the final move lower, or so it seemed. It looked like the market had set up the opportunity for the whole early June to date action, starting as a bearish halfway hesitation that seemed to be morphing into a late June, early August descending expanding wedge pattern, with a fairly flat upper trend line currently at 282.30 and a significant lower trend line currently 258.40. All this was enough for me 6 weeks ago to set out some targets below for such a descending triangle and descending wedge pattern. Thus for the descending triangle we had a primary target in the 273.20 zone, for secondary harder to reach target X down at 255.60. For the descending wedge pattern we had a primary target down in the 272.30 zone, for harder to reach secondary target X1 down in the 242.80 zone. As you can see, both primary targets for the descending triangle and descending wedge pattern have been achieved, leaving last week the harder, in some cases much harder to reach secondary targets further down. Early last week, what I thought might be a halfway hesitation that morphed into a descending expanding wedge pattern morphed again, this time into a lopsided reverse head and shoulders pattern. A typically bullish pattern, a reversal pattern, the one that does have bearish continuation patterns. This week prices challenged and overcame the overhead colourful congestion of the bright red downtrend and purple lower trend line, plus the August 2020 low at 281.90 and a significant green short medium moving average currently 281.30, and above all these I suppose the neckline of the new reverse head and shoulders pattern currently at 282.30, moving up as far as testing the mauve medium moving average currently 289 even, and venturing up into a congestion area where the lows of December and November last year and March, April and May this year also reside, plus congestion between 282 even to 300 from April to August 2020. That's where they reside. I should also point out that the 50% Fibonacci line for 2025 is also there at 294.5 and a now flatlining gold long moving average currently 295.5. I now wonder if these will temper the rise we have seen these past 2 weeks and maybe turn it back down. In the meantime, I have some possible topside targets for the newly constructed reverse head and shoulders pattern of a primary target X in the 296 area, for secondary harder to reach target X2 up at 301.60. I am wondering if these will be fulfilled with what I can see as a congestion overhead. Finally, this commentary would not be complete without my discussing the elephant in the room, or at least the elephant in the room which has stayed there throughout 2024 and also resonates now into 2025. And that is the annual key reversal seen here at the end of 2023. I said, and I'm afraid I have to repeat something I've now highlighted for 114 weeks, yes, well over 2 years now, and I quote, "And I only need to remind you once again of my words when I pointed out the Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023. I've been living in the shadow of this pattern ever since." End of quote. I've also added ever since, and I quote, "If there is only one thing you take away from any of my musings, let it have been those words," end of quote. These last few weeks have shown once again that the shadow cast by that supremely significant pattern so long ago still darkens the skyline of this market today. Chicago soybean oil. 8 weeks ago, and we had a gapping move lower that punched up and out of the earlier showrunner here, the shallow bullish shift pitchfork for the mid-September to late December 2024 move. Now, I'm still keeping the trace outline of this pattern on my daily chart, and the broken upper time, currently at 52.26, will become relevant again soon in my discussions. Anyway, 7 weeks ago, we stabilized over this broken upper time and pushed higher over the 50% Fibonacci on the March 20, April 22 move at 53.59, and utilizing this 50% Fibonacci line as a base for the next move higher. This 50% Fibonacci is actually quite interesting, as it's the gateway to overhead congestion that stretches from 56.34 till at least the top of my daily chart in the 59.44 area. All this action had earlier caused a monthly key reversal up here for June, and this leads me to what may be the more dominant pattern right now, and one I mentioned 9 weeks ago. It was, as I said at the time, and I quote, "A new pattern emerged over the last month or so, and one that I warned may kick off 2 weeks ago," so that's now 11 weeks ago. I continued, and has actually done so since, though the break has not fully stabilized as yet. It is the dark blue, start of April, end of May, ascending wedge pattern. And that's the end of the quote, and that's currently 51.63 to 60.44. This pattern has the appropriate number of touches on each side. Now, back late 11 weeks ago, we had a brilliant break and breach lower, but as I said 10 weeks ago, and I quote, "Clear consecutive closes below the dark blue lower trend line, I would feel obliged to lay out potentials and even possible targets below for this pattern, something I am not confident in doing just yet, as I fear a possible false break lower," end of quote. Since then, this pattern has repaired itself, and we are back well within it, climbing higher during most of July after June's monthly key reversal up, but turning lower once more in late July with a weekly key reversal down 2 weeks ago, when prices tried to enter the overhead congestion stretching from 56.34 up to 59.44, and found out how only too easily it eroded the bullish incentive. Now, there's one other feature I'd like to draw your attention to, is to look at the possibility that the lows of April and June can come together to form a new lower trend line, currently at 48.16, highlighted in bright green on my daily chart. This would be a new lower trend line to the original ascending expanding wedge pattern. I've still not fully explored this idea as yet, but I do feel obliged to lodge it in both your mind and my mind, just in case. Finally, back to the broken upper time mentioned earlier. This week, in the market's efforts to head lower, support, especially on a closing basis, has been seen by the rising green short medium moving average, currently at 52.87, but also by the broken upper time. If these two supports break down, then the dark blue lower trend line of the ascending wedge pattern will be under threat, something I think it may not cope with very well. And if that goes, then we start filling in the changeover gap left over from June and testing the next support, the singular mauve rising medium moving average, currently at 50.74, as well as the old March 2013 high at 51.26. And to be the devil's advocate on this, if these go, then the green uptrend and the potential mentioned earlier of an even larger pattern may be on the cards. And right now we are down towards below. We're down towards 10. We're below that broken old upper time and down towards almost, but not quite, almost testing the dark blue lower trend line of the expanding ascending wedge pattern. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.